Walk me through the call.
Yeah, absolutely. So, the first thing we do is we acknowledge that there are risks out there. So literally the title of the piece is there are 5 key risks for the equity market. Those would be the trade war, Fed tightening, oil decline, the Chinese, slowing that we've seen, and then the tech sell-off. And then we try and kind of go through each one of those and talk about how much, if any, the market has discounted each of these different risk factors. And what we're realizing is we've gone quite a ways as far as trying to price all these different things in now, because what's interesting is a lot of these issues were here when we were at 2940 on the S&P, and now we've declined by 10%, and a lot of these issues are still here. So what that tells us is we have started to discount finally a lot of these problems, and for our investors who are willing to kind of accept some volatility and kind of look for the long term, we think this is a great buying opportunity.
So, Sameer, your basic message is that the political risk shapes sentiment. We're certainly seeing that now, but it's the earnings that will shape market trajectory. What is your view on the earnings?
Absolutely. So we think we will get 177 on the S&P for next year, and I went on Bloomberg and I took a look at the consensus, which is around 178. Now that's down from 180. So what that's telling you is, for us, for the consensus, the earnings picture for next year really hasn't changed. So all of the decline that you've seen has really happened on the sentiment or the PE side. And so if you look now, the S&P trades at about 15 times next year. In a world where you've still got about 3% on the 10-year and Fed funds is still around 2%, that's a pretty compelling valuation.
So, Sameer, right now, when I speak to credit investors, I speak to a lot of people that think we've seen the cycle tights. Why have we not seen a cycle top in this bull market?
So we easily could have seen the cycle tights, but if you look at the last 2 cycles, what credit tends to do is it tends to tighten, and then it tends to go sideways for a while. It happened in the last cycle, and it happened in the 90s. So, again, we would not dispute that you have probably seen the tights in high yield, which is why we are unfavorable, and we would much rather have investors take that risk on the equity side. But what does tend to happen is the credit cycle tends to run a couple of years ahead of the equity cycle. So again, we don't like high yield. We are unfavorable. We want people to take the risk more on the equity side and higher quality equities as opposed to credit.